The path to consistent profits in trading or investing is elusive, but attainable. All it takes is to discover your own unique method. Your trading system's rules determine your interaction with the market and, though it may seem inconsequential, it is the foundation of the game. It must outline your entry and exit points, trade management, and risk strategy. Today, we delve into the process of constructing a successful trading strategy and the questions that must be answered to create a steady system. First question: are you a market expert? The initial step in designing a strategy is deciding which currency pairs or stocks to trade, as not all systems are suitable for every market. The question becomes, what type of trader are you? You must choose between two basic trader profiles. The first is the market expert, who focuses on a single market and gains an in-depth understanding of the market's personality, the factors that influence it, and a means of gauging its mood. Market experts often achieve high win rates and significant profits. Second question: are you a trade specialist? If the notion of trading one market does not appeal to you, consider becoming a trade specialist. This means focusing on a single trading setup, which must be tested through back testing to gain experience and confidence. As a trade specialist, you must become comfortable with all aspects of the trade: the beginning, middle, and end. The beginning is the most critical stage, where you act as a filter and eliminate subpar trading setups. The second stage is managing the trade, and the third is the exit. Your exit strategy must reflect your unique personality and approach to the markets. Third question: what time frame do you prefer to trade? Choosing the market is crucial, as is selecting the time frame you're willing to trade. Three questions must be answered: your trading personality, the amount of time you have during the day, and your patience. Shorter time frames require intense concentration and patience, while longer time frames offer more stability. Fourth question: what is your risk appetite? The simplest rule is to consider how it affects your sleep. If you can place a trade, set the orders, and sleep peacefully, the trade size is suitable for your risk profile. If, however, the trade keeps you awake and preoccupied, it is too big and must be reduced. Fifth question: what is your maximum drawdown? Your risk appetite and maximum drawdown are closely linked. The maximum drawdown is the amount you are willing to lose over a given period, and it can be tracked weekly or monthly, depending on the time frame you choose to trade. Your maximum drawdown affects the number of trades you can take at any given time, so it must be considered carefully. Sixth question: how will you manage your trades? The way you manage your trades is a personal decision, with two parts: managing the entry price and managing the exit. Some traders prefer to make all decisions before the trade is triggered, while others prefer to manage the trades actively. The choice depends on your trading personality and weaknesses. A well-defined trading strategy, with all variables defined up front, makes it easier to navigate difficult times, such as drawdowns, losing streaks, and bad luck. In conclusion, pressing the buy or sell button is just the tip of the iceberg. It's crucial to define not only what you will trade, but also how you will trade it and the precise rules that govern your system. If you found value in this lesson, please show your support by liking this video, subscribing to our channel, and hitting the bell icon to stay notified of new uploads. Until next time, happy trading!